In today's housing market update, I'll be talking about why I believe the data is showing that we are actually in the eye of the storm, as well as where interest rates are now and state of the end, where I'll show you when the mortgage rates will be coming back down and my advice for buyers, sellers, and investors in our current market. So let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty, and in today's market update, we are seeing the eye of the storm. There aren't a whole lot of drastic swings or changes in the market trends, but I think this is the calm within the eye of the storm. So let's get into what I mean. In today's housing market stats for the southern part of Southwest Florida, new listings went from 620 last week to 696 this week. That is up 12%. However, we will see that the actual inventory breakdown has really not changed much and has actually gone a little negative. So solds went from 561 last week to 760 this week. That's up 35%. Again, solds is a lagging indicator that's indicating what was going on 30 to 45 days ago. So those are all homes that went under contract at least a month ago and really don't have any bearing on what's going on in the current market today. Pendings, however, on the other hand, are the leading indicator. That went from 792 last week to 816 this week. That's up 3%, and I believe that is indicating just what has been going on with the mortgage rates. People have been starting to flock to mortgage rates before they start going any higher. Another story here, price decreases went from 701 last week to 795. That's up 13% as well, which is a good sign for buyers. And I think in the coming months, you'll see that it will continue to slide that way. Moving on to the actual inventory breakdown. So single families went from 4980 last week to 4972 this week. That's down 8. Condos, which is everything else other than single family homes, went from 2086 last week to 2075 this week. So that's down 13. So we had a net loss of 34 last week. We have a net loss of 21 this week. Really not any huge jumps considering the amount of inventory that comes on and goes off every day. Really, the trend is showing that it's staying the same. We're kind of hitting a balanced market right now as far as what's going on and coming off. Multifamilies went down 6 from 180 to 174, and foreclosures up 1 from 43 to 44. Not many huge changes here, but do keep in mind if you've been paying attention with multifamilies since I've been doing this show for the last over a year. Multifamilies, that is a right near all-time highs for the number of listings on the market at any given time. All right, moving into the northern part of Southwest Florida, from Punta Gorda all the way up to Sarasota, new listings went from 1546 to 1595. That's just up 3%. Solds, again, lagging indicator, went from 1593 to 2052. That is up 28%. So you can see the trend here in both north and south parts of Southwest Florida. Pendings, 1973 last week to 2032 this week. That is also up 3%, same as the southern part of Southwest Florida. Again, the price decreases in this part a little different than the southern half of Southwest Florida. 2303 to 2268, really not down a whole lot, but down 2% overall. Now the inventory breakdown for the northern part of Southwest Florida. 4048 for single families last week, 4045 this week. That's down 3. Condos went from 1377 to 1402. That's up 25. We had a net loss of 10 last week and net gain of 22 this week. Not any ground shaking or earth shattering changes here or swings. So again, showing pretty much a balance here now. We're kind of rocking back and forth between net gains and net losses in very low numbers. Multifamilies, 77 to 70. So we lost 7 this week. And then foreclosures, 37 to 19. That's down 18. So that is a little bit of new data there. Looks like investors are still heavily investing in the northern part of Southwest Florida, which would be probably a good indicator of multifamily purchases and foreclosures. All right, moving into today's interest rates. These are the interest rates as of yesterday. 5 went from 5.7 last week to 5.88 this week. That is up just a little over 15 basis points. And then we had bank rate 5.89 to 6.05, which is up over 6 now. Keep in mind, these are just national averages as a whole. Hey, shameless plug. If you're getting value from this video, can you let me and YouTube know by hitting that like button? I'd really appreciate it. All right, let's get back to the stats. All right, so now I want to break down and get into really the interest rates for mortgage rates are going to continue going up. And I've talked about this. If you follow the bond market, the 2-year bond, that's a pretty good indicator of where the mortgage rates are going to be heading. So today I'm actually going to show you when the interest rates are going to be heading lower. And I'm going to show you that right in the graph and show you exactly how you'll know when they start to go lower. So let's get right into the charts, and then I'll go through at the end my take for and my advice for buyers, sellers, and investors right now with the current market conditions, and my projected forecast over the next few months. All right, so right now I pulled us into TradingView, and what I have up here right now is the 2-year bond. 2-year bond is in blue. This particular chart goes all the way back to 1989, which is when we were taken off of the gold standard. So that's really when this chart starts, and it goes up to present day. And then I overlaid that in orange with the federal funds rate. The blue, the actual bonds did start to go up. And as soon as that started to go up from February to March, so within 1 month, the Federal Reserve decided to start raising the rates. Now you can see that this happens throughout, and each time there's a decline is right around when we had a recession. So you have 1994 into 95, you have 2000s, which is the dot-com bubble, and you have back here 2006 all the way through to 07, and you see that the federal funds reversed again. This starts to increase again in 2016 up until 2019, and then it lowers again. But then in February 2020, if you remember what was going on in the stock market back then, and then we had the virus came out, and that's when they completely reduced it all the way almost to zero. Now you can see the blue bond market has been rising really since September of 2021. It slowly started, and then right about January 22, it really took off and it almost went vertical. Ever since then, we've been talking about the Fed being behind the 8 ball. In March is when the Fed decided to start raising the rates again, and they are now starting to catch up. The Federal Reserve has to try to raise the federal funds rate to the point of wherever the actual bond market is. Now, they usually do not ever get there. As you can see, they don't ever make it back up, and they never make it back to previous highs when they had to raise. So this is really the law of diminishing returns. They never actually get back to where they tried to get before, and a lot of times they don't even make it to the peak of where the bond market says they should be going. And instead, what happens in this little section right here, right in this area, as you can see, when the blue line crosses the orange line, or when the federal funds rate crosses the bond market, that's when you start to see that everything starts to subside and the Fed decides to reduce the rate. Now, looking at this chart right here, you can see that the Fed is almost caught up to the bond market, and the bond market has actually started to level out a little bit. It hasn't completely dropped. Actually, today it's down 1%, but it has started to plateau a bit. Now, when the federal fund, they're going to probably raise the rate another 75 basis points this next upcoming meeting. When they do that, they'll be pretty close to where the bond market is. When that happens and the bond market starts to subside, inflation starts to subside, and the bond market starts to go down the other way. But the other indicator here at the bottom is also so this is the RSI. This indicates when a market or a stock is underbought or oversold. And right now, when it gets to the top of the chart, which the purple is indicating that it is, the yellow starts to catch up to that. As soon as that starts to get in there, people start to sell it off, which means that this is about and getting close to a time to actually sell off. So when that sells off, the bond market goes down, and that is when the lines will cross. So this does take some time to play out. This is a couple decades that you're looking at in a chart right now. So this does take a few months to happen. But like I've been saying, I think probably after the elections, November, maybe December, so maybe early winter, but I think late fall, we're going to start to see this actually go the other way. And I think we will start to see the Federal Reserve start to reverse course a bit. However, in the midterm right now, we're going to be seeing some more pain. So what does that really mean for you as buyers, sellers, and investors? So let's start out with the buyers. For one, buyers, you're kind of, like I said, you're in the middle of the eye right now. Interest rates are still high. They're right around 6%, or in the high fives. So it's not the best time to buy, necessarily because the interest rates are up. However, now that we're starting to see home prices come down, I believe they've dropped about $6,000 on average across the nation, and definitely more in certain pockets. More specifically in Southwest Florida, prices are starting to come down. Homes are sitting a lot longer. Where they used to be only on for a few days, they're now sitting for a couple of weeks, on average. Um, at the same time, we're also seeing the prices being reduced 10, 15,000, in some cases more than that, um, reduced, and then offers that are being put in for buyers. And I have buyers right now that we're doing this for. We're putting in offers that are lower than the asking price, which is not what we've seen over the last 2 years. Most of them have been at asking price or more, and waiving contingencies. So if you're a buyer, the competition's pretty low right now. So it is a good time to buy. The only thing is the interest rate is a little bit higher. Now, I'm guessing, and it's of my opinion, that interest rates will be coming down a few months from now. However, we don't really know where the economy is going to be. Nothing is really certain. On the other side of this, for sellers, this is really, I think one of the best times to sell, because one, you're still kind of at the top of the market. You might not get what you could have gotten a month ago for your home. However, you also have a better opportunity to buy when you do sell. So if you're planning on selling, I would say my advice is selling right now is probably in your best interest. But again, that all comes back to what's your interest rate now. If you have a lower interest rate in your home and you're going to be trading to something that not only is priced higher than what you're paying right now for what you bought it for, and you're also going to be adding on a higher interest rate to your home, then this might not be the best time for you. However, if you've been waiting to buy or sell because you've been waiting to buy, I would say now is the best time to. Even if you have to rent out for a few months, I think you're going to have some pretty good opportunities coming up on the buy side in the next couple months. And I do believe that interest rates will be falling. Now, as far as investings go, it really depends on the type of investor you are. Are you a long-term investor? You're a buy and hold, or are you trying to flip? I would say if you're a flipper, this is not the best time to buy. You have, lower competition, but you're still paying pretty high prices, and the market is not trending upward anymore. It's actually trending down. So the chances of you making a profit have gone down some too. But really, it comes down to, how are you underwriting your deals? What's your cap rate that you're looking for? How realistic is your overhead? Also have to factor in the fact that things are sitting on the market longer, so your overhead and carry costs are going to take more out of that profit margin. But if you do it carefully, there are still deals to be had. On the other side, if you're a buy and hold, for most part, buy and holds don't have a whole lot of things that they really have to worry about. As long as the deal makes sense, if you're holding it long term, prices appreciate over time. It's always on average about a 3% appreciation rate. So the appreciation really isn't the main factor. Again, something to think about if you are planning to buy. When the interest rates do go back down, demand is going to pick up as a buyer. So you're going to be fighting the crowd again when that happens, as well as the fact that prices will be coming down. Thanks for watching. If you learned something from this video, give it a thumbs up, and don't forget to subscribe and hit that bell to get notified when more videos like this get released every week.